All right, welcome. Today, we're going to break down the two totally different mindsets that literally build our cities. You've got the lender and you've got the owner. It's a fascinating story of two players who can look at the exact same building but see completely different games.
Okay, so let me ask you something. You're standing there looking up at this huge, gleaming skyscraper. Do you want to be the person who owns it or the person who put up the loan to get it built? Seriously, your answer to that one question tells you everything about how you think about risk and reward.
So first up, you've got the lender. And their entire world, their whole reality, revolves around one simple question. How do I make sure I don't lose my money? It is all about playing defense. But the owner, oh, they're starting from a completely different place. Their question is all about offense, all about growth. They're asking, how do I make a lot of money? It's all about the upside. And this, right here, is the heart of the whole thing. The lender is playing defense. Their focus is risk. Look, for a lender, the absolute best day they can have is just getting their money back, plus the interest they agreed on. That's it. Their upside is totally capped. The owner, on the other hand, is all offense. They're focused on the return because their potential reward is, well, basically unlimited. The sky's the limit. All right, so let's really dig into the lender's world for a minute. Their entire playbook is written with one single goal in mind: protect that investment no matter what. For a lender, the game isn't about finding the next big thing. It's about building a giant protective moat around their money. Their priorities are all defensive. We're talking downside protection, creating a margin of safety, and valuing stable, predictable cash flow way more than explosive growth. Think about it. They would much rather have a boring tenant who's guaranteed to pay rent for 20 years than some flashy tenant whose rent might double in 5. So, how do they actually build this fortress? Well, the first brick in the wall is a little something called loan to value. You'll hear it called LTV. It's the most basic way they measure how much skin they have in the game. Let me show you how this works. It's actually pretty simple. Say a property is worth $100 million. If a lender only puts up a $65 million loan, that instantly creates a $35 million equity cushion. So what does that mean? It means the property's value could literally plummet by 35%, a huge drop, before the lender even starts to sweat about losing a single dollar of their original loan. That's a massive cushion. Okay, the next big one you gotta know is the debt service coverage ratio, or DSCR. If LTV is all about the asset's value, DSCR is all about its cash flow. And all this really asks is a simple question. Does the building make enough money each month to pay its mortgage and still have some left over? Yeah, so lenders, they're typically looking for a DSCR of at least 1.25x. But what does that number actually mean? Well, it's all about that cash flow cushion. It means the property's income could drop by a full 20%. And guess what? The lender still gets their check on time every single month. It's a huge safety net. So at the end of the day, a lender's dream isn't some shiny, new, exciting building. No, it's a boring one. One with a 20-year lease locked in with a big credit-worthy company in a stable market. They honestly couldn't care less about massive growth potential, as long as they know without a shadow of a doubt that those checks are going to clear. Okay, so now let's flip the script. Let's go to the other side of the table and look at the owner's playbook, which is all about playing offense and chasing that sweet, sweet upside. And right away, you can just feel the shift in energy, can't you? The owner's whole language is different. It's all about upside, growth, and opportunity. They're hunting for a high IRR, an internal rate of return. And they do that by actively trying to create value, maybe renovating a building, betting that rents are about to shoot up, or trying to time the market perfectly. And here's the kicker. This is the owner's superpower. They use the very thing the lender is so careful with, debt. It's called leverage. By using the lender's money, an owner can control a huge $100 million asset with only, say, $35 million of their own cash, and that just supercharges their potential profits. Okay, so hold on. If one person is trying to avoid risk at all costs and the other is trying to juice returns, how on earth do they ever work together to get a deal done? Well, the answer is a fascinating concept called the capital stack. You can think of the capital stack like a ladder or pecking order for who gets paid first. Right at the very top, taking the least amount of risk, is the senior debt. That's our lender. They get first dibs on the money. And way, way down at the bottom, taking the most risk, is the common equity. That's our owner. And you see those other pieces in the middle? Just think of them as different levels of risk and reward sandwiched between our two main players.
And this right here, this is one of the most fundamental rules in all of finance. The lender gets paid first, so they take the least risk. And for that safety, they get a smaller, predictable return. The owner agrees to get paid last. They take on the biggest risk, but in return, they get to keep all the profit that's left over, the whole thing. Okay, that's the theory. But let's make this real. Let's take a look at 5 completely different buildings and see how our defensive lender and our offensive owner would look at each one. So you've got an office building, right? The lender's looking at it and getting nervous about work from home trends. The owner sees the same building and thinks, hey, maybe I can convert this into apartments. Now, what about a multifamily building? The lender loves it, so many stable tenants. The owner loves it too, but they're excited about the chance to raise rents. Even hotels. The lender hates the daily ups and downs of revenue, but the owner accepts that volatility because it comes with a shot at much higher returns. You see the pattern? It's the exact same asset, but it's like a mirror. It just reflects back the goals and fears of whoever's looking into it. All right, let's wrap this up. This great divide we've been talking about, it's not about who's right and who's wrong. It's about 2 roles that are both absolutely essential, but they require completely different ways of thinking to succeed. And this table really just puts it all in one place, nice and clean. The lender, the credit side, is all about that contractual interest and protecting the downside, using tools like LTV. The owner, the equity side, is optimizing risk for reward, chasing that big IRR, and using leverage to get there. It's 2 players, 2 totally different playbooks, all centered on the very same asset. So that brings us all the way back to where we started, standing in front of that giant skyscraper. Understanding this whole dynamic is it's everything. It's how our cities get built. And so the real question I have for you is this. Now that you know both playbooks, the cautious defender and the risk-taking attacker, which game are you built to play?